So our panel today, which I'm sorry that the chairs are they told me to stay here. So I've heard complaints about the chairs, but I'll sit in one at times too. We're going to be exploring the future of Israeli investments with an emphasis on defining Israel as an opportunity for a dedicated allocation and focus. We have a great panel. Immediately to my left is Robert Katz of Senvest, Michael Zaremsky of Leumi, Harry Heyer of Unterberg, and Michael Waxman-Lenz from the Technion. Israel's a very small country. You already heard statistics of that. And so an investment in Israel has to be a conscious decision. If it's not, many investors, I would say most investors, are unintentionally underweighting Israel. If you just use the global benchmarks, Israel is less than 25 basis points of the total world market cap using MSCI or FTSE indexes, less than 40 basis points of international equities, so equities outside the US, and only about 50 basis points of developed markets. If you only use that, and most institutional investors only use that, you're not getting complete exposure to Israel, and in our opinion at BlueStar, you're not getting sufficient exposure. Active managers often have even smaller exposures because they've just made decisions. Eran just asked me about Teva. Teva has been a big part of it. And so we feel that investors need to look under the hood of their portfolio and make that conscious decision on investing in Israel. Following the decision to make a dedicated allocation to Israel, you have a benchmark decision. And Josh talked to you a little bit already about benchmarks. We'll get into that at some point, but we certainly think implementing with an index or a smart beta version of an index is one way, or active. And then if you implement with active management, do you take a broad approach to Israel, or do you take a sector approach, for example, tech? So for us, this panel is at the heart of our conference. How do people invest in Israel? What are the opportunities? From a top down, what is the decision to allocate? And we're going to discuss that with Michael. Working with clients at a private bank, at a wealth management firm. We're going to talk about that with the other Michael. Bottom up, how do the Israeli companies surface to an active manager? For someone like Robert, who has a dedicated Israel fund, it's how do those opportunities, how do you choose amongst those? And then for Harry, who has a broader tech fund, how do you choose the Israeli equities? So aside from actual people allocating and investing money, there's a broader ecosystem that supports this decision. There's sell-side research, such as that produced by Jefferies, or now the research that we're also disseminating together with Jefferies. There's investor relation firms that bring companies to meet investors. And there's exchanges which do some work in promoting the companies that have listed on their exchange. So this summit and the follow-up dialogue is part of that process too. So I'm going to direct some opening questions to each of the panelists. I've got some pre-arranged questions as well. Those are the softballs, but I'm hoping as we go through, you'll warm up your fastballs because we want this to be a good Israeli discussion, meaning we'll end with some yelling and debate. So I'm going to start first with the top-down decision, and I'm going to start with Michael. Michael is the CFO for the Technion Society of America. They manage, well, you have many responsibilities, which you'll tell us about, but they also have a large endowment invested, like most endowments, invested around the world. And so to date, even though Technion has produced so many incredible Israeli companies, and Technion grads are leading many of the great Israeli tech companies, as far as I'm aware, Technion has not yet made a dedicated allocation to Israeli equities. But I'd like you to discuss why that's not such an easy decision. I know your committee has started discussing it. What are some of those issues? And in relation to what Miami has done, sort of where do you guys fall on that? Sir.
So Stephen said I won't be allowed to leave here until we make a commitment. Right? So no, but in terms of the endowment, it's very important to look at the structural management of an endowment. and also of the temperament of the committees, the investment committees that are many times managing. So in our case, the endowment is driven by a mandate to support the university with the highest returns and the distributions. And the investment committee has a temperament that says that's our goal. It is advised by an outside consultant, and then the investment committee makes the decisions. So I think we're going to have a discussion around what role do consultants, allocators like OCIO services play in this decision-making process. So in our case, our portfolio has roughly a 5% allocation to fixed income deposits in Israel. Thank you to the Ministry of Finance. We're getting a very nice, solid, low-risk return there, and this was a no-brainer. On the equity side, it's a little bit more challenging because it is not necessarily in the purview of the consultants, and we can discuss. Steve and his company have suffered through the reviews from them and what they felt, to put this highly ranked compared to the entire universe of other investment options. And so my last comment is, right, if you're an investment committee, you need to have conviction beyond that we are one of the feeders, from the university perspective of the ecosystem, the entrepreneurial. So there's obviously a strong impetus to support that, right? And now with the Cornell Tech, Jacob School here, the runway programs, those are all entrepreneurial efforts. But when you move over to the endowment, it becomes a very bottom line oriented, where do we get the highest return? And the last comment would be, and it's a little bit that saying, why don't we hire IBM? I won't get fired for that, right? So maybe not IBM nowadays, but it is that feeling, you as an investment committee member, you have to have a real conviction to step up almost to a stock selection part, right? To convince the rest of the committee we want to do that. And that needs to be supported by the investment advisors and other allocators.
So fantastic answer. And also to put a plug in for the next panel, this issue, whether endowments and foundations that have some affinity to Israel or connection to the Jewish community, do they, the board members, the staff, have either the conviction or the obligation to make that decision, or at least tell the consultant, look at this, and there'll be a great discussion about that in the next panel. But thank you very much for that, Michael, and we will revisit that. I now want to go to Michael Zaremsky, who is relatively new in his position at Bank Leumi Private Bank, and you'll tell us about your role, but you've had the opportunity, being new in your position, joining an Israeli bank in the US, to look afresh at the issue of, our clients know we're Israeli, they perhaps might have an affinity for Israel. How are you looking at providing that? What are the issues that come up? You already offer some. What are other, new products, and how does that discussion go?
Terrific. Well, Steve, thank you, first of all, for inviting me, and thank you, everybody, for attending. When Steve invited me to the panel and kind of posed the question of how do you view Israel as an investment opportunity, it's very challenging because, again, we're in a little bit of a different position than many in the room because we're actually fiduciaries to our clients. So from a fiduciary standpoint, a lot of what we're grounded in is what's in client best interest, and then it's really a question of determining how do clients view Israel, and kind of working down from that, the first question is, what does Israel investment mean? And we struggle with this because many of our clients have a lot of vested interest in Israel already. Some of them may be Israeli citizens, some of them may own Israeli real estate, some of them may have private equity investments, they may have businesses that are tied. In many cases, they may own bonds or may have shekel exposure. So when you start to go through what our clients look like in terms of what their Israel exposure is, in many cases, there's a lot of exposure. And then I think one of the other issues and challenges is Israel is a very emotional issue for many people, but as kind of head of the New York private bank, most of our clients are really concerned about returns. So when we start hearing the emotional arguments from some of the vendors of Israel product, it gets challenging because at the end of the day, our clients are seeking return. And speaking with some of our clients and some friends of mine who are in the philanthropic community, their general comment is, if I want to make a charitable donation to Israel, I can do that myself through a charity or foundation. I don't need to do it to the bank, to the board of directors of Leumi or to a hedge fund manager.
Keep us in mind, okay?
Exactly. So they have many choices, many options. We have a lot of clients that support the IDF and a lot of people that support a lot of different charities. So the commitment to Israel can mean a lot of different things to a lot of different people. And again, just kind of looking at some of the areas, again, is it bonds, is it equities, real estate? And then I think part of the other challenge that we start to have is, what is the point of exposure? How do we get access to it? And access is an interesting question because, again, you start to deal with a lot of issues of what's the appropriate exposure. And Stephen, this is something that you've dealt with and struggled with in terms of defining the benchmark, defining the universe. You start to talk about liquidity. So again, for some of the access points, if you're in the hedge fund world or private equity world, the minimums start to creep up pretty high, and then to really get adequate diversity for a portfolio, you need to be a significantly high net worth investor to gain exposure. We're not talking about a $100,000 investment, we're talking about big size. And then you start to get into some of the issues of costs and minimums. So as we look at all these opportunities, we start to weigh out where are the opportunity sets, where are the right points of contact. Again, ETFs in a lot of cases are a very useful way of getting into it, but the problem with a lot of the ETFs from our client perspective is, again, determining what is Israel. Is it Israel stocks? Is it Israel-related companies? How much of my Israel-related companies do I have in exposure in other elements of my portfolio? And making those decisions is not always such an easy element of it. And then, again, I think from the last point, ties into this concept that a lot of people struggle with is, if the Israel exposure is 0.5 in terms of the global index, for our asset allocation solutions, if we want to make a stand and make a prominent point about Israel, we could be taking a significant benchmark exposure. Again, we're generally comfortable with Israel risk, but we are a fiduciary, and we are telling clients that we're targeting a particular return based on a benchmark. And if the benchmark is typically looked at as the MSCI equity index, and we decide we want to make a bold stand of a 5 or 10% allocation, that's a very, very meaningful bet. And then we start to run into this question of, is that a risk we really want to take in a risk-adjusted portfolio? So these are some of the issues that we struggle with our clients. And again, I think that the key issue is, it's not a one-size-fits-all solution to gaining exposure into Israel. And again, from a client wealth perspective, where every client has a unique set of opportunity or unique circumstances, it gets challenging for us. And what I would implore all of you is that when you're making the case to people on it, it can no longer just be this emotional issue of helping Israel. We all talk about Israel as a startup nation, but after 70 years, I don't think many people, particularly the wealthy entrepreneurial class, view it as a startup opportunity anymore. They view it as a sophisticated country. They view it as a place where we're no longer downtrodden. And again, it's all about making returns. And that's kind of how we look at the situation.
So that word, returns, is going to be the perfect segue to Robert. But before I turn it to Robert, I want to emphasize that not just BlueStar, but anyone who is looking to, I don't even want to use the word convince, but educate about the opportunities in Israel. But certainly we discuss returns. And in your packets, if you look at the first page that shows the BlueStar description of ourselves, you'll see a chart. It shows the BlueStar Israel Global Index since 2000 compared to the world. And what it shows is that Israeli equities, when properly defined, meaning all Israeli equities, has trounced global equities. That doesn't mean it will do it every quarter. It doesn't mean it will do it next year. But when we talk about people being aware of what's in their portfolio and being aware of the opportunity of Israel, there's a reason we created an index, and there's a reason we created an index that now has more than 15 years history. It's so people can say, what if I had invested in Israel 5 years ago, or 10 years ago, or 15 years ago? What would that have looked like in the portfolio? Earlier today, Josh talked about emerging markets. It was very hard to make the case for emerging markets in the early 90s. People needed to see an index and a benchmark, and what does this returns mean? It's exactly the same reason we created this index, so people can understand that investing in Israel is good for your portfolio. It's not about being good for Israel. If it helps Israel, that's nice, but it's about being a good investment. So with that point, I'm letting it seep in. I'm going to pass it to Rob, because the story of Senvest and how Senvest decided to launch an Israel fund has to do not with Zionism, but opportunity. So
that's
tell
exactly
us.
right. So We started our fund in 2003. The genesis of the fund was basically an outgrowth of our largest fund, which was started in 1997. And I oversee technology investments at Senvest. And in the 90s, going to Silicon Valley, down to Texas, to Boston, really scoping out the domestic technology scene. We kept coming across undervalued Israeli companies that were highly innovative, and they've made their way into our portfolio. We're value investors in growth industries, and basically in 2000, after the tech bubble burst, we had the Iraq war going on, as well as the second intifada. Israeli equities really fell on hard times. Many of the foreign analysts dropped coverage of these stocks. Most of these stocks were US listed. Many of the same brokerage firms closed their US shops. We took a very contrarian view. We saw this as a tremendous value opportunity and stepped up to the plate. And we thought it was a risk worth taking. So we started the fund in March of 2003 with $2.5 million. We've grown that today to over $140 million. Senvest was a family office. It's now an institutional platform with over $1.5 billion under management, as my colleague Eric pointed out in the last panel. Over $500 million is in Israeli-related equities. A lot of those equities are US-listed equities. Probably 95 are in US exchanges. We have been defining the universe for Israel since 2003, and even predating that, have been looking at a lot of these companies. We see it as a tremendous opportunity that is often, or in the past, has been very overlooked. A lot of wealth flows into VC, into the private equity side, but public equities somehow missed out. And even after we started our fund, we had probably a more difficult time marketing the fund than we would have thought. People were very skeptical of the returns, skeptical of the size of the market opportunity. And what we've seen, again, is that the addressable Israeli market has grown from roughly 50 billion to over 300 billion in public equities today. And we think that is just the beginning. We think many of the companies coming to market are going to be, they're coming later, they're bigger, they're stronger, they're more global in nature. Israel is not just innovative in the technology develops, but they're highly entrepreneurial. And innovation without the commercialization of all these inventions is waste. I mean, the Israelis are really seizing on these opportunities. And the companies that we are investing in today are much bigger, more globally focused, have better management teams in place. And we think that the opportunity ahead of us is as good as the opportunities that we've seen over the last 15 years.
Thanks, Robert. I want to turn to Harry now. Harry is an analyst for it's a global tech fund. You'll tell us about it. And because you're looking at tech all over, certain Israeli companies have earned their way into your portfolio. So if you could tell us a little bit about the portfolio, how Israeli companies have become prominent in the portfolio, and what the opportunities are that you see.
Absolutely. So Underberg Capital is an all-tech, small-cap hedge fund. We're much smaller than Rob's fund, but most of our Israeli-based investments have come to us not because a portion of our fund is earmarked for Israeli-based investment, but because of our small-cap focus, our fund lends itself in a lot of ways to emerging technology companies, and certainly, you know, it's no surprise to anyone in this room that a lot of the public Israeli companies are not only technology companies, but they're on the cutting edge of technology and much more likely to be, you know, quite frankly, small and fit our investment mandate than some of the public American tech companies, although there are plenty of those as well. So, you know, we really look at, we look for stocks that are great companies with great management teams, as Rob pointed out, but importantly, in technologies that we think are transformative. And I think that Israel certainly has a very high concentration of transformative technology companies that have presented themselves to our fund, and it's not always easy to find them, but within this world of small cap tech, they do kind of have this tendency to find us. Sometimes it could be Hayden bringing them through town. But if you're looking in the world of small cap tech, I think you're necessarily looking at emerging technology. And that's kind of how, currently about 25% of our fund has been allocated to Israel-based technology companies.
Great. Before we get to audience questions, I will go back to you and to Robert on some of the people want to hear about those companies. But before I do, I'm going to go to Michael Zaremsky. Leumi has a major tech investment bank and even a brand, Leumi Tech in Israel, and sees the early stage companies. I would think that your clients in the US, for purely profit-seeking reasons, would be saying to you, Michael, give me some tech, give me some of this cool stuff. What are some of the ways that you either are addressing that need or plan to address that need, aside from telling them about the ETF that tracks our Israel Tech Index?
Yeah. Again, the question goes back to a kind of point of access, point of availability, and what fits into each client's portfolio. So, Bank Leumi USA is a New York chartered bank, so we have a relationship, obviously, with Bank Leumi Israel, but a lot of stuff is kind of arm's length because of all the rules and regulations, which my one other comment is I just wish the government was as adherent to all the rules and regulations that they impose on us. So I'm sure everybody would agree with that. But I think that, so when we look at it, we have done some deals with private equity firms where we've been, exclusive distributors. We have had some opportunities with Israel-related hedge funds where we're exclusive distributors in the United States. And there are other products that we're continually looking at. Again, one of the challenges that I see and that we see for our client base is, again, a lot of the opportunities, and even that some of these gentlemen mentioned or some of the other folks had mentioned, it's very difficult for us to get involved or engage in purely small cap stuff, even though the Israeli market is changing in terms of startups coming to market later and bigger. Still, in a lot of ways, I don't believe that the dream and the vision of most Israeli entrepreneurs is to become the next Facebook as much as it is to sell to the U.S. tech company or to get listed in the U.S. exchange. So again, those access points in terms of where the real opportunity set is get a little bit more challenging for us, especially when we think about it in terms of a client's asset allocation. And kind of the last point on it, and again, which I go back to a lot, every client is different on the high net worth side. And for many of our clients, they think technology investing may be really risky because they're real estate guys. And their diversification in real estate is East Side, West Side, Brooklyn, and they don't really need to go beyond that because there's no risk involved in real estate. So again, everyone's got their own. That was a joke for anybody who wasn't paying attention. But again, I think a lot of it is the parameters of what they want to do, and I think that the other issues that we deal with is a lot of people that are, again, for our U.S. investor base, they have plenty of technology holdings here, and when you balance that out with what their portfolios look like, how much do I really need the Israeli tech exposure when I'm fully exposed on many other fronts here to technology in the United States? So it's a question of fighting for shelf space within that asset allocation model and then kind of balancing that out with access, liquidity, and cost structures.
You mentioned one point that's going to be discussed this afternoon, so I just want to foreshadow a little bit. That issue of, in the past, Israeli entrepreneurs were happy with an exit or just the IPO, but that is changing, and there will be two panels this afternoon discussing how the dynamic is changing, especially as you have more serial Israeli entrepreneurs. The other point I just want to mention is the tech exposure in the US, we all know, is quite high, and I'm sure you're managing that risk. The tech exposure in developed international markets is actually quite low, and Israel's a developed market. So if you want to have the proper tech exposure in developed markets, you might consider Israeli tech. Before, again, we go to stock stories, Michael, you at Technion, as an institution, have an incredible high-class problem. You've got alumni making fortunes from their technology. You now have campuses, not just in Roosevelt Island, but in China, with an amazing backstory, because it was actually the fortune not fortune, he was already a multi-billionaire, but Li Ka-shing, China's richest man, or previously China's richest man, was an investor in Waze. And with his exit profits, he actually funded Technion's new campus in China. But you have incubators, you have technology, that you even have an IP development. So with all that knowledge and wealth coming out of Technion, is there pressure or issues to you at the CFO level or the board level, we should invest more in Israeli tech, more from that angle?
I mean, I think one thing you're pointing out is this financing continuum, right?
Yeah.
As we sit here, especially in my role, I'm an institutional investor. Very different profile, very different objectives than if you go to the earlier stages of investment. And I think Robert made a very important point, and it came up earlier. Capital markets have also changed. In my prior life, I was an executive for a dual-listed company, Tel Aviv, NASDAQ. Life is not that much fun as a small cap company, right? Even with Harry on your side. You know, they have a short-term investment horizon, so there's a lot of pressure on those companies. So the trend that Robert pointed out, that you want to get bigger and come to market later, has a real impact, and it has a particular impact on Israel, which has this amazing ecosystem of young entrepreneurial companies. But when you look at the structure, right, there are lots and lots of small companies, not a good universe for our institutional investment appetite. There's a small universe of mid-cap kind of markets, the ones that probably Harry would be interested, and then there are very few large ones. And so I think the time horizon, even though Israel is 70 years old, right, that's a relatively recent phenomena and has a real impact on when we as institutional investor will actually be interested in. So there's a long lead time for VCs, private equity firms, right? And as the companies stay longer private for the reason that, you know, it's hard to get coverage. I mean, we're in the New York Stock Exchange. Really, the pressure on public companies, especially if you're small, is quite substantial, and the reward to go public, you know, as much as we hear the success stories, right, coming from where I came from, you see the day-to-day of a small public company, tough, challenging, and so I think that backdrop is really important to look at the time frames, you know, when you become qualified to get into an index, at which point you're probably good for a portfolio that's managed institutionally. And so there was a long answer to say, we don't have a lot of pressure because of that institutional investor perspective, right? We put money, our philanthropic donors put money in different ways, much earlier, incubators, you know, funding, postdoc and PhD students that want to start companies, very different vehicle, not focused initially on ROI return.
So I'm going to turn to Rob for two reasons. I was going to ask you to tell some of the success stories, companies you love in your portfolio, but as a segue to that, you and I have talked a number of times how we see, and people like Jeffrey see, you know, more potential for larger Israeli companies, and there's an appetite for that. So,
yeah. I was just going to segue into what Michael was saying. I mean, I think even on the public side, I would say particularly on the public side, we're really seeing a lot of companies growing up. There's really large multi-billion-dollar market cap Israeli public companies, US listed, and they're in high growth mode. They are doing M&A of non-Israeli companies globally, and the reach of many of the problems that these small, innovative public companies have is they create a new product, but getting it to market is always challenging. They're usually founder-run. All the dollars on the P&L are flowing into R&D. The concept is you build the better mousetrap, everyone will come buy it. And that's farthest from the truth in the marketplace. You'll be outmarketed by an American company 99% of the time. I think the mindset of these larger, more successful Israeli companies has changed dramatically. They're adopting global marketing teams, chief marketing officers, and really there's a maturity going on, a maturation within the Israeli investable universe. And we're seeing companies and I could probably go through a whole list of them, that like Orbotech, Tower Semiconductor, Mellanox, and I'm probably going to miss a few just out of, there's so many of them, that it's just phenomenal today to see these companies and have tracked them over time to they're playing with the big boys and they're doing a good job at it. And they're becoming thought leaders in their spaces.
Harry, a variant of really the same question. So companies have to earn their way into your portfolio. What are the, and you mentioned disruptive or transformational tech, which is a theme we see, and it's a theme we use to explain our tech index. Give us a few examples, either the sector or the type of tech or the company themselves, just to get people to understand these are real companies with real business.
Well, I think first of all, you know, in total agreement with what Rob is saying, I think that because of the fact that a lot of these Israeli companies may have a better mousetrap and may simultaneously be having a very, very difficult time bringing it to market, you know, I think as an active manager, what you want to know is that the competitive differentiation is going to be there for a long time, because it might take a while for the company to get recognition. You want there to be buzz, or you want the ability to generate buzz eventually, because if you don't, a lot of the time what happens is that you fall into, you know, what my fund manager and I call small cap hell, which is that you could have a great product, but nobody cares. And I think that a lot of the challenges and opportunities in small cap tech generally are the same ones that Israel companies generally face, which is, you know, I think on the earlier panel, Rob said that, you know, there's just not that much street coverage. There's just not that much institutional support. You might have a great product, but an American investor, you know, a big American investor just doesn't care or can't invest or whatever. You know, for us, those are opportunities. And we are a small enough fund that we're able to be nimble. We're able to take positions that would be minuscule to another fund that are big to us, and hold them for a long time. But really, to your question, you know, within the technology space, I think, you know, our portfolio is made up of companies really across technology. It's semis and semi-cap equipment. It's certainly cybersecurity, and that has, you know, in a lot of cases, an Israeli bent to it as well. A handful of small medical companies. You know, AI, autonomous driving, robotics, you know, these are all spaces where, you know, I think that the opportunity investing in Israel specifically within small cap, you're going to get a lot more pure play companies. And for better or worse, you know, they trade at big discounts. The Israel discount, you know, I've heard more than one person use that phrase, and it's a real thing. Because you could have, you know, an Israeli company over here doing the exact same thing as an American company over here, and the valuation is just, they're worlds apart. So, you know, within our portfolio specifically, I'm not gonna, like, we don't really talk too much about our holdings, but, you know, certainly cybersecurity is one of the key areas of focus.
I want to touch on, since you mentioned valuation, and I know Rob has some views on it, it's interesting because when we look at the top-down valuation of Israeli tech, it doesn't seem cheap because you do have some large companies that aren't highly profitable. But I know, Rob, you do believe that there is an undervalue effect, but it's been changing. So if you could just sort of give us an update.
Definitely from when we started the fund, which at that point in time was deep value. At that time, there were 20 US listed, publicly listed Israeli companies trading with negative enterprise value, just to frame it. I don't think you would find that today. But there was an Israeli discount, even without those events happening. And that discount went all the way into the notion that it was cheaper to actually do R&D in Israel, which I don't think today would be the truth. I think today people see it's more efficient to do R&D in Israel, and you have all these multinationals locating there and partnering with Israelis. It's not cheaper to do it there, it's actually better to do it there. And that's great for the economy. I think as these companies are maturing and getting larger, they're getting more on parity with their US counterparties. I think within the small cap realm, there still is a discount, and we do participate to some extent at that level, but as our funds have grown, and this was something we asked ourselves, will we outgrow this opportunity to do what Harry's doing? And what we found is that the Israeli companies have grown with us, and the trend is not to sell out. The dream, even when you are public, was to sell out to an American, get bought by Cisco, get bought by Microsoft. I believe Wix was, at one point, was saying that's my dream, to be like the 5th app in a Microsoft suite to build your website. I think today a lot of these companies look at themselves as freestanding, large Israeli-based multinationals, and they do get respect. There's a little bit of a maybe a geopolitical haircut that they get, but I don't even see that creeping into it these days. I think actually Israel is one of the safer places to locate your company and your business. So I think that discount is going away, and I'm glad to see that.
Yeah, we see that as well. And again, there'll be 2 panels this afternoon discussing the decision process for Israeli tech companies, because there are quite a few unicorns already that could have gone public, have chosen not to. There are those that are seeing signs of life in that pipeline. And
I would even argue that Israeli companies should have a premium based on the amount of innovation and success that they've had.
could you repeat that?
Israeli companies should trade at a premium to their global counterparties because of the rate of success that they've had and the amount of innovation coming out of Israel.
It's not an irrational thought. And it also underscores something that was said, which is why so many global multinationals are in Israel. They're not there because they're Zionists. Right. They actually have sometimes even have shareholders saying they shouldn't be there. They're there because the ecosystem is so valuable. Programming and software developers are more efficient, and they want to be part of what's happening. And it's also why when Intel acquired Mobileye, one of the key decisions was, we're not only not taking Mobileye to Silicon Valley, we're going to make Jerusalem the headquarters for all of Mobileye's autonomous driving technology. And I think we'll see more and more of that again. I want to ask the audience to start thinking of your questions. If you have any right now, feel free to raise your hand. If there are none, I'm going to call on a few of you because I know. So we have our first question. Before we take Marla's question, though, is there anything about where you stand on this issue that I haven't fully gotten out? Any key points?
I would just like to make one point,
please.
which I think is interesting. And again, I'm looking at it more broadly of what is the Israel opportunity set. And I think that it happens in the United States, it happens in Israel, it happens everywhere. There's oftentimes a disconnect between the economic vitality of an environment versus the equity market. And I think one of the things that we're seeing, and you spoke about earlier, one of the reasons why the bond market is so healthy in Israel is because of all the economic activity. And in many cases, the economic activity is not necessarily showing itself in the equity market. So again, if it's the global multinationals that are taking advantage of the vibrant economy in Israel, again, it's generating revenue, it's generating jobs, it's generating tax receipts, it's generating a lot of things that make the Israeli economy extremely healthy and help create the 3% growth rate, which make it very attractive from a bond standpoint. But again, the economic benefit is not necessarily going into the Tel Aviv Stock Exchange. It may be showing up in Intel, Microsoft, Qualcomm, or you name the tech company that's bought the interest. Again, so Mobileye is now part of Intel. The economic benefits are accruing to Jerusalem. The equity benefits are accruing to the United States. And again, that's why I think
where the taxes go.
I'm sorry?
That's where the taxes go.
Exactly. And the people that are working there and everything are in Israel, so it's great for the economy. It may not necessarily be taking place in the equity market.
I mean, Israel doesn't want to be the R&D center of the world.
Absolutely, and this is why, again, one of the reasons for this conference and one of the reasons for some of the research we've done, and we're going to continue, is we feel that Israel needs more big companies that are going to keep the jobs and so on. But one point, and I'm really thrilled you raised that, Michael, is it's not complete disconnect. So we have, aside from our standard BlueStar indexes, we actually have divided Israel into a global exposure index, so Israeli companies that are exposed to the global economy, and a domestic economy index. And Israel's economy goes through cycles. Our most recent monthly update actually just discussed this. Many people don't know this. I think Rob hinted at it. the domestic Israeli companies, the ones exposed to the strength of the economy, including a bank called Leumi and a bank called IDB and a bank called Hapoalim, they're incredible investments because they are directly exposed. Same with retail, same with real estate. Even when these foreign multinationals come into Israel, guess what? It's not just that they're hiring people, they have to rent office space, and they usually rent Class A office space. So there is investment concepts that can benefit from the growth of the domestic economy while Israeli companies succeed abroad.
I'll just add to that,
Yep.
I think that that's absolutely right. From out where we sit, in the small cap tech world, it's very hard to invest in small cap tech without a very, very high level of scrutiny on the quality of the underlying technology. I mean, a tech company with no technology is dead. And, I think that when an investor struggles to dissociate, their perception, which probably at this point, is not even right about Israel from a geopolitical standpoint, from the quality of the underlying asset, there, frequently would be a very good opportunity, and that's a lot of the time what we've seen, and I do hope that it closes, as perhaps it would make sourcing new ideas harder, but it would certainly help the existing portfolio names.
Well, I do think one thing that is going to close this gap, and there was a discussion at a previous panel over whether these new high-tech funds will be a huge success or not a success. But as Israeli domestic investors finally start investing in Israeli tech companies listed abroad, that is going to, not right away, but it will affect the valuation as these become more integrated in their portfolios. The young lady in the pink shirt had a question.
Well, definitely having the track record helps speaking with investors today versus back in the early days. We had a vision and trying to share that vision with other people who clearly did not see it. I think you just have to get out there and do great events like Stephen is doing today to get in front of people. And I think the ETFs are a great way of demonstrating that, hey, here's something that's trackable, look how it's done over time. I think myself, for Senvest, getting out and telling the story and sharing our returns, which I cannot do today for compliance purposes. But just people can see it when they look at the stocks and the success stories within Israel in the public markets. It's not just unicorns that come out of the private side, but some of the names and themes that are at the forefront of driving multiple technology themes have Israeli tech companies that have touched or are major contributors to those themes, whether it's AI, cell phones, communication technologies, medical devices, innovations in biotech, you name it. It's an amazing feat that Israel has, the level of involvement that they do in all these different areas.
I'm happy to take a kind of stab at answering it in a different manner. I think part of it goes back to, again, from our perspective, we put together a lot of risk-based asset allocation models. And ultimately, for better or for worse, the starting point typically is MSCI World. And I think part of it is when you think about how Israel is positioned, I think that the question really becomes, are you thinking about Israel as a core exposure? Are you thinking about it as a tactical exposure? Or frankly, are you thinking about it as kind of an emotional or political exposure? So I think you need to bucket how you want to make the investment. What is the purpose of the investment? If the argument is trying to be, it needs to be a bigger part of your core investment, even if you double the size of it, it's still a 1% allocation. So I think that the way that I would think about it, or the way that I would position it, is typically you have, if you had a 60-40 portfolio, 60% equity, 40% bonds, a lot of what we think about is, what is the carve out for alternatives? So if your alternative allocation is going to be maybe 20%, so you'd kind of say, break it out from equity and fixed income, you have 20% alternatives. Maybe there's a tactical position in the portfolio that should be in the alternative bucket, which is kind of away from the core equity or the core fixed income. And this way you can actually find an allocation that makes sense for, again, whether it's just the tactical opportunity of we like the economy, whether it's kind of and again, you could probably speak more to it from your point of view on the foundation side of it. If you're an Israeli foundation, maybe you can make the argument we should have a 5 or 10% allocation just because of who we are. But again, that takes it away into a different realm of it. But when you're thinking about a core portfolio, I think some of the arguments get a little bit challenging just because we all are benchmarked, we all have risk return parameters, and it's difficult to step too far outside of it. So I would think about it more in a tactical sleeve or an alternative sleeve of what's the appropriate exposure level.
I agree with what Michael's saying. And I think part of it is also how could you not have exposure to it? There's a risk of not having this exposure. Right. How could you be missing out on this opportunity?
And that's exactly what Marla was pointing out. That was the wake-up call that the Minister of Finance gave to the Israeli institutions for not.
We saw that long before Mobileye was.
Of course you did.
But the key issue here is when you define that it's an opportunity cost as opposed to a risk. So again, by not owning it, you're taking, let's say, a 0.5% benchmark tracking error risk.
Right.
By not owning it, you might be taking an opportunity cost risk of not owning it.
Understood.
And I think those are two different elements that need to be communicated appropriately, and I think that's where it all fits in.
Yeah. Michael, let me just flip or challenge what you said based on how some endowments and foundations got to where they did, and this will address Marla's point. So you heard earlier today from Alon and the Miami Federation took a look at what they already had in Israel bonds, and they said, why don't we just do the same with Israel stock? That was based on affiliation, but they also looked at the history. Another major federation that was an early investor in Israeli equities is the Chicago Jewish United Fund. It's one of the largest in the federation system. They looked at what their active managers were doing, and they saw that almost universally, especially after Israel went from being an emerging to a developed market, their active managers were inadvertently underweighting Israel. They said, well, we do have an affiliation, and we're going to compensate for what our active managers aren't doing. So it wasn't just based on heart. It was based on math, and they ended up making Israel, at that time, 8% of international, which is an overweight, but it combined both. But just so people don't think that 0.5% is a small number, Alon this morning said that the federations and all the American friends of Technion, Magen David Adom, Synagogue, et cetera, if you take all of the Jewish and pro-Israel affiliated endowments just in the United States and Canada, it's at least 60 billion. So even 1% is 600 million. The 3 ETFs that are trading downstairs here at the New York Stock Exchange for Israel, 2 of them track our index, 1 tracks some other index, have $130 million, okay? Singapore has $1 billion. Philippines has $400 million. There's an anomaly right now, and some of the answer is that those organizations that are connected to Israel or care about Israel continue to give all their charity to their cause, but also look at Israel as an opportunity. So you might hear this again before I close. Any questions? Mr. Daravoff, thank you for being here again.
My pleasure. Please call me Phil, Steve. We've been friends for a long time.
Okay, Phil.
So I have a question for Harry and Robert, and it's mostly on the practical execution of the ideas that you generate. The securities that you may be looking at could represent small companies who are relatively illiquid compared to a lot of the things that trade in this building. And that the positions that you'd like to accumulate might be relatively large compared to the liquidity. And so it's a challenge in getting in at the prices you think are reasonable and getting out. And so I'm wondering how the structure of the markets that these companies are traded in and the liquidity affects the companies you ultimately decide to invest in. And are there some companies that look very interesting, but you just can't accumulate the position without moving the price, or you don't think you'll get out, you'll be able to get out?
Right. I'll start by saying, just maybe I have a little more history on this, that there have been over time small cap companies that are illiquid. And our approach to investing in these companies has been to take a broader view of the technology in the markets that they participate in, as opposed to a company-specific investment. So when we're looking at an investment in a small cap Israeli company, we've already looked at the competition, typically in the US, sometimes in other places. We're looking at the end market in which they're going after and the health of that and the prospects there. And many times these small cap companies are illiquid and take a long time to get into. If you're right, exiting isn't the problem. As they are successful, they get bigger, and that's the dream. I think everyone who's ever done small cap investing, whether it's in Israel or anywhere else, is sometimes getting in is a challenge, but if you're right, getting out, there's a lot of liquidity on the way out. If you're wrong, that's when getting out and liquidity is a big issue. So you better have a good track record. Otherwise, you end up in, what do you guys call it? Small cap hell?
Small cap hell.
Because you have to hear about it for a long time.
I agree with that. I think that, in our case, again, just mainly due to the fact that we're a relatively small fund, a 1% or 2% position for us is very rarely too big to accumulate. 1% of our fund might constitute a large portion of the daily volume in a liquid stock, but eventually we can get in if we want to. There are other instances where we've done transactions that have allowed us to accumulate size faster. But I think that within the small cap world, there are a couple of different dynamics that create opportunities, and the challenges are the opportunities. First of all, from a coverage standpoint, if you're doing the work and nobody else is, you could have a leg up, or you could have a great idea that you're the only person who thinks it's great. There are a couple of institutions that help identify great opportunities. Certainly on the research side. Jefferies, I think, is a good example because they really have focused on Israel. They've taken a very proactive approach to bringing Israeli-based investment ideas to investors. They do a tech trek that I think is really popular. But with regard to the challenges that are opportunities, liquidity can be an opportunity, because if it does pan out, you could be one of the few guys out there that actually has stock, and certainly you're rewarded because other investors might given the news, clamor to get their hands on it. The lack of research coverage, again, it presents an environment where perhaps identifying great ideas is more challenging, but if you really dig into the weeds on these companies and you understand what they're doing, and I'm not an engineer, so I have to spend a lot of time talking to customers and talking to the management team and understanding why what they're doing is so good. And if the price is right, which a lot of the time with Israeli stocks it can be phenomenal. But again, it's, I view the challenges in small cap tech as really being the opportunities, and that certainly extends to the Israel-based, listed equities.
I would say at Senvest, as we've grown up, we've had less of the small cap exposure. We're more in the mid cap space right now is our sweet spot. And even there, we're taking pretty large positions. So there's still that. We're typically a top 3 investor in the companies we invest in. And we're not shy to go over 10% in some of these investments as a holder. And we're looking for a 2 to 3 year hold time, sometimes 5 years. And we're looking at a really long-term roadmap for a company. And so short-term liquidity doesn't really bother us as much in many of our investments.
I would just say one other thing. We have a handful of positions where, you know, due to the ownership in the company that we have, you know, we've had a more active dialogue. We're not activist investors, but we've had a more active dialogue with the management of the company, and that's kind of, you know, to the point, some of the points that were made on the earlier panel about this, like, you know, public investing that kind of looks like VC. It's really hard, and you know, I think that concern, I think it was Eran brought it up, is very real. What venture cap guys do is really, really challenging, and they have a different skill set. And that's not to say that it can't be done in the public markets, but you know, I don't think most companies aspire to be small and public. And so if they are for a long time, it's usually because something's broken. You know, we certainly try our best to collaborate with management, but that's really not our business. So again, that can be an opportunity, but it can be a pretty big challenge as well.
Thanks. We have time for one more question, and I saw a hand going up right over there, Mr. Natiganor.
This is less of a question than it is a commercial,
Stand up.
Then stand up, so.
I just wanted to make a point to Phil's question. I think it's an important one. A lot of the positions that these guys take are in fairly liquid names. And recognizing that's a problem, that no matter how good an investor they are, they can't cure that challenge. One of the things we spent a lot of time at Jefferies doing is covering all of the local institutions in Israel, incredibly closely, these holders of these names, and then really understanding who the ecosystem in the US, whether it's Senvest or Unterberg or a few of the other participants that are very active in this space, and understanding, because much like you see with VC and then growth investors and public investors, there are people who are invested in these stocks at different points in their maturity and for different reasons. And what we're hoping to achieve over time, and I think we're slowly getting there, more, is to kind of become that central clearing place, that epicenter of trading of those names. There were a few examples in the last several months that I think both of you guys at some point have probably seen it happen. There was one particular day that happened to me where we got a call from a very large hedge fund in the US that was long 400-something thousand shares of a very liquid security, which traded 20,000 shares a day. They had made a lot of money in it, and for no fundamental reason other than the fact that they wanted to put their capital elsewhere. They wanted to exit the name. It was a name that we knew Rob had done support on. Through institutions in Israel were looking for liquidity. Every time they tried to sell a share, you know, you could move the stock, and ultimately, I think we were able to put the entire 400,000 share block across into the hands of 3 institutions without any market impact at all. At that sale, everybody felt great on both sides. We didn't take risk at all, and it was really helpful to the investors. They called us to say thanks on both sides, and we're really happy. So we're trying to kind of figure out how to do more of that, because you know where all the bodies are buried, it's a lot easier.
Poor analogy. Yeah. So with that advertorial to close, I first and foremost want to thank our panel for being here and sharing these. And the title of the session was Exploring the Future of Israeli Investments, so let's keep exploring it, keep the dialogue going. And with that, I want to pass on to my colleague, Joe Levin and Zoya Rains, and you'll have a great session coming up now.